To start, we'll take our first question from Jeffrey Demendez from Bank of America. Jeffrey, your line is now open. Feel free to unmute.
Hi, good morning, everyone. Thank you for taking my question. I just have one in this case. Jose, I think you mentioned you're going to get about more than 3 billion of GMV from that deal. Any detail that you can give on potentially the take rate, or at least if you think that as soon as the deal starts, you're going to be profitable on the partnership with Richemont? I think you said in the past that FPS was a profitable business, so just wondering if there is any reason why that wouldn't be the case with this one. If you need to do investments up front or anything like this, that would be helpful. Thank you.
Hi, Geoffroy. Thank you for your question. I think, first of all, this is an absolutely transformational deal for Farfetch, for Richemont, and for the industry. And the deal comprises 3 parts. All of them are GMV and revenue generating, in fact. Starting with FPS, which you mentioned. Yes, it's over $3 billion of the most recently reported digital GMV of Richemont. That means we see upside there, of course, because we see this naturally growing and after completion of the deal with the replatforming, expanding the Maison's reach to new geographies, improving the conversion rate, vastly improving YNAB's capabilities, really will extend that GMV. This also includes the addition of practically all of the Maisons to the marketplace. So if you think, all of those Maisons and their ranges, which are very hard to find online, in fact, these are not normally easy to find in certainly not in online wholesale. That in itself is a significant GMV opportunity for us. And finally, in terms of YNAB, adding the Net-a-Porter supply to the Farfetch marketplace, this is an incredible addition of supply. By far, it will be the largest seller, I think, just off the top of my head, on our marketplace. And conversely, providing extra liquidity of injecting our resale and pre-owned inventory and end-of-season inventory into YOOX. All of this is highly revenue generating and very accretive from a profitability perspective. You are correct. FPS is profitable as we stand, and will continue to be profitable. We cannot comment, obviously, on the commercial rates of the deals. That is commercially sensitive. What I can say is that in 2023, this is estimated to have a positive EBITDA and cash impact, even as we build the platforms, because the commercial conditions were built in a way that as we build, there is build fees and incoming revenue to offset investments that Farfetch is going to have to make. Of course, this means that we need to get ready. We're onboarding very large customers, very large enterprise customers. This is not just this deal. It's Salvatore Ferragamo, it's Neiman Marcus Group, it's Reebok. And therefore, we this year sees an increase in headcount in FPS, but we will cover that, later this week when we speak about you. But all in all, very accretive, profitable on the FPS side of things from day one, and cash generative from day one.
Our next question is from Doug Anmuth from JP Morgan.
Thanks for taking the questions, and congratulations, Jose. I did just want to circle up, and I understand maybe you need to wait a bit until tomorrow, but I was curious about at least higher level some of those investments that you need just to support the larger scale on FPS and the marketplace, and then just curious on feedback from some of the other luxury groups like LVMH and Kering, just as you've been going through the process here.
Thank you, Doug. Yes, it will be a chance tomorrow to update you. Overall, we've been anticipating this. You will remember me saying that this was going to be a transformational year for FPS. Well, here it is, right? So we have been gearing up as we saw the progression of these deals, really making sure that the roadmap and the strength of our engineering team really was there to absolutely develop the capabilities at scale. So a lot of that investment has been made. Of course, a little acceleration in terms of depending on how fast the solution design, etc. On the other, because obviously this deal is still pending regulatory approval. The other deals such as Salvatore Ferragamo and Neiman Marcus, etc. we have obtained or do not need such approval, so those will move faster. We'll update you on Thursday, but really it's largely built into the business plan that we shared with investors back in May. On the other groups, I think this is a fantastic day for the entire industry. Let's not forget that over 1,000 luxury brands sell via YNAB. These brands want to move to e-concessions. Many of the larger players from Kering and from LVMH, some have already moved to e-concessions on YNAB, but not with the capabilities and the efficiencies of our architecture. So this is absolutely fantastic news for them, but for many other large, medium, and small brands that will have more audience, bigger sales, but also different modes of selling. So not only the wholesale mode of selling, which for smaller brands probably will continue to be important, but a combination of wholesale plus direct concessions, like we have at Farfetch, right? So we have the Browns business, which is our 1P business, but we also have the direct concessions. Many brands are present in both. So we see the same model being extended to YNAB, which allows YNAB to keep the curation that differentiates it while being much more capital efficient, cash generative, and profitable. So this is really a transformational day for everyone in the industry.
And our next question comes from Stephen Ju from Credit Suisse. Stephen, feel free to unmute and ask your question.
Okay, thank you so much. And Jose, congratulations on the partnership. I'm interested in following up on the demographic slide in which you called out the differences between the audience on Farfetch versus Net-a-Porter and also Yoox. Maybe this is too early to tell, but should we be thinking that there is actually very little overlap between the users on these destinations? Thank you.
It's a great question. I think it's very important to highlight how complementary these destinations are, these banners. This is a very vast, very large industry, and we see different customer profiles and different modes of shopping, and this really complements the Farfetch marketplace destination. I won't repeat myself, but we do believe that these are different customer profiles, different demographics, different geographies, AOVs, as you can see on the data that we provided. I'd also like to say that even if you combine the GMV from both businesses, we're still talking about 3% of the entire industry, right? So that's incredible growth to go for. We still see the Farfetch marketplace continuing to grow at the 30% CAGR that we've always indicated. That won't change. If anything, we have more supply and more curated supply, so that will accelerate the growth of our marketplace and more channels for our markdown mix, which, as you know, we've been deliberately reducing the markdown mix. So with Yoox, there's a potential dual listing there. So if anything, this is an acceleration of our marketplace growth. But there is, such a vast, greenfield ahead of us for all of these banners, and they're very complementary to your point. So we're very excited about the possibility in a few years' time of creating this portfolio of highly complementary brands.
Our next question comes from Louise Singlehurst from Goldman Sachs. Louise, please unmute and ask your question.
Hi, everyone. Hi, Jose. Thank you very much for taking my question. I suppose that the key question, Jose, to you is how you envisage the end game for the consumer. And I guess in the past, we've talked about the consolidation of apps and the number of apps that the consumer will download. And I guess here there's an opportunity for a customer to have 5 apps from just one group on their telephone. Or put another way, is this really answering the question of the big problem with online and luxury, i.e. you're trying to segregate the offer between the full price and then the off-price or markdown selection. So hopefully a little bit more full price offer for Farfetch as well as Net-a-Porter and Net-a-Porter. Thank you.
Thank you, Louise. I think, the strategy doesn't change. So on the Farfetch side, the ethos of Farfetch is that of a two-sided marketplace. And the Farfetch brand is about choice. It's about the most comprehensive selection of brands and boutiques. And it is appealing to a very young international customer, right? We have deliberately been reducing the markdown proportion of our sales, which was always low. I think we've updated you in QnA was 75% full price, 25% markdown. So it's already very low. We were always a majority full price business, as our AOV indicates. But we will continue to reduce the markdown mix. So the strategy hasn't changed. What changes here is the obviously potential significant boost to the supply by adding the Net-a-Porter inventory, which benefits both parties because obviously expands vastly the addressable market for Net-a-Porter, and also creating a channel for that markdown supply to be sold via Yoox, and that vastly expands Yoox potential in terms of growth as well. So I think, the strategy of the three businesses, I would say 3 brands because there are 5 in reality, but the strategy of Farfetch, the strategy of Net-a-Porter and Net-a-Porter, which is called the luxury division of YNAB, and stays essentially the same. With Yoox, we believe in a rebranding and repositioning because we think that outlet is not necessarily a very relevant online outlet, a very relevant positioning for brands, and even for customers. I think customers are much more keen on thinking about end of cycle circularity of a mix of new but end of season with new resale like stadium goods and pre-owned resale. So this really appeals to the same customer very often. And for me, that is where you will see a strategic repositioning of that brand. And I think that can be very, very powerful.
Our next question comes from Lauren Shank from Morgan Stanley. Lauren, please unmute and ask your question.
Great, thank you. Just wondering if you could elaborate a little bit more on the scale and cost advantages as a result of the initial deal, and then should you end up acquiring the entirety of YNAB, what some of the cost synergies and margin benefits there could be in terms of taking on the entire entity. Thank you.
It's a great question. I think in terms of the initial part of the deal, and that is a good for potentially 5 years before a full acquisition of YNAB. So in terms of the initial part of the deal, I think this clearly scales our platform in a very powerful way. It essentially doubles our digital platform GMV. You have seen us adding large enterprise clients, for example, Harrods and other 20 luxury brands that use FPS. And in spite of that, our tech spend as a percentage of revenue has been coming down, and it's coming down consistently. So we've proven time after time that this is incredibly scalable. We can add very large multi-billion-dollar turnover companies to FPS with continuing at the same time to drive leverage of our tech and infrastructure spend. So in terms of operations, of course, as we scale, everything gets more efficient from our ability to have DHL, UPS, FedEx, advantageous rates, to the ability to drive scalability in operations, customer service, etc. So we see the FPS deal and the onboarding of the portfolio to the marketplace as very, very scalable. And of course, we're fully aligned with Richemont here in terms of making YNAB incredibly lean, efficient, and profitable by leveraging as much as we can the Farfetch platform. So as you know, we have built into the deal conditionality that YNAB has to be EBITDA positive for the put call to be exercised and for a full acquisition to happen, which means that shareholders are fully aligned in driving very strong operational efficiencies. And of course, that's by leveraging the Farfetch platform capabilities.
Our next question comes from Oliver Chen from Cowen and Company. Oliver, feel free to unmute.
Hi, congratulations. Jose, regarding profitability, what's the vision for the key drivers of profitability at YNAB, and also how does it alter your path to profitability? YNAB also has a very great last mile service. We use it a lot. Could you comment on any thoughts around their DCs and that aspect of the business and how it may synergize with your current offering? Thank you.
Thanks, Oliver. I think, first of all, YNAB historically delivered strong profitability and strong growth. It's been in recent years where the tech legacy has really weighted in the business as the industry became so much more competitive, with obviously brand.com coming into the equation and a number of very good, online retailers coming into the luxury space. The lack of digital, cutting-edge digital capabilities. Obviously, if you're an e-commerce business, that's all you do, right? So it's very impactful to their performance. So in spite of that, actually, the business is almost profitable, right? So in the last reporting period, I believe it was negative 20 million in adjusted EBITDA. Richemont talked about most of that being actually relative or attributable to the Fengmao JV in China, where they're still investing heavily. So in spite of the operational inefficiencies and tech inefficiencies, the business is almost breaking even. And what we see is our technology coming in and delivering leverage and a lot of expansion of margins through not just the technology but also operations, better conversion rates with better localization of the offering, more channels with the addition of Farfetch Marketplace as an incremental channel, more supply with the addition of our supply onto Yoox. So we see very significant levels of profitability, and this absolutely will not be at the expense of the user experience. On the contrary, the idea is to continue to leverage the great things that YNAB is already offering to customers and continue to evolve them and actually improve on those services.
We have time for one more question. This final question today comes from Edward Yruma from Piper Sandler. Edward, your line is open.
Hey guys, thanks for taking the question. I guess just real quickly, YNAB seems to have been one of the more egregious offenders from a promotional perspective. I know that you're going to have a sub majority ownership, but I guess how quickly do you think they or you can stabilize their inventory position? Just as a quick follow up, Richemont also throttles back the inventory on the hard luxury maisons to what they offer online. Do you have any kind of commitments from them in terms of the product offering that they'll allow to be retailed online versus in store? Thanks.
Hi, I'd like to start by disagreeing with you. I actually do not think that that Net-a-Porter, Mr. Porter, are big promoters or discounters online at all. We actually, obviously, as you would expect, we absolutely monitor the competition on a daily basis. We scrape all those websites out there. There's a lot of competition in the market. And what we see is sometimes people who you wouldn't expect actually are ones that are promoting more. And it really depends sometimes from quarter to quarter whether they have a little bit more inventory or less inventory. So I think it's in line. It's certainly not out of line with the rest of the luxury online landscape. Having said that, I think it's clear the large brands want e-concessions. And this is a tremendous advantage for Farfetch. Because we are pioneers in the e-concession technology. It's true e-concessions. It's not what I call e-consignments. It's not like we require the brands to ship the inventory to our warehouses, which is very inefficient and actually doesn't increase the depth or the choice of inventory, actually decreases it for customers. This is a true drop shipping e-concession model, and this will be incredibly attractive for the brand. So today is a transformational deal today marks a transformational deal for Richemont, for Farfetch, but also for all the other brands that want to advance the 3P model. They want to advance e-concessions, the drop shipping model, but haven't been able to do that with YNAB. And by the way, with other online players where they've been trying, but not getting very far because of the technology limitations that they have. So what we see is full price mix increasing as a result of that migration to 3P at YNAB, and profitability as a result increasing as well as a lot of release of working capital. Because when you move a business that is 100% 1P to a significant material percentage of 3P, you do release a lot of cash and working capital, and you become much more profitable and efficient at the margin level. So that's what we see. And then I didn't catch the second part of your question. Okay, my team just updated me. So in terms of the high luxury on the marketplace, look, Richemont is incredibly excited, as you probably had a chance to listen to Johan and their team today. They have had a very good experience with Alibaba in terms of e-concessions on Tmall. Very, very powerful channel for Cartier, which is one of the most demanding maisons in their portfolio. This has clearly demonstrated that the e-concession model works for them. And is very beneficial both in terms of brand image representation and access to customers. And this deal obviously opens the Farfetch channel as a channel. And this is, I was listening to the Richemont call, and Burkhard was very clear to say, this deal is not really about the consolidation but really about us leveraging the Farfetch platform for our maisons. And this is the driver of our decisions here. So, they're very excited, and they have seen the success of e-concessions. And to your point, this opens the right model at Net-a-Porter and Mr. Porter, because before the company until now has not been equipped with the e-concession capabilities that the maisons want. So even internally in the group, the technology was not equipped to service the needs of the maisons. All of that will change, and will change very quickly as soon as we complete this deal.
I want to thank you all for joining us. I know it was a bit of short notice, so thank you for making the time to join us for our call today. We look forward to speaking to you tomorrow to talk about our Q2 results.